Welcome to the next edition of Veritas Financial Analytics lecture videos on the calculation of economic damages. My name is J.W. Verrett. I'm a professor at George Mason Law School. I teach forensic accounting. I teach corporate and commercial transactions. I teach business law, financial regulation, a number of courses. I also run an expert witness firm where I work as a forensic accountant and an expert witness in a number of other related issues, questions of materiality, interpretation of M&A agreements. And I have a network of scholars within Veritas where we can find you the help you need. Okay, so this is the second lecture in a series of two. Our last lecture focused on estimation of individual economic damages. This lecture focuses on estimation of economic damages for businesses, commercial economic damages. Some of the approaches I'm talking about today, if you want to get a good guide, are described in Stanley Stevenson and David McPherson's book, Determining Economic Damages by James Publishing. It's a good resource for the forensic accountant in measuring economic damages. Let's get into it. So in measuring commercial economic damages, there is some wrongdoing or some alleged wrongdoing, depending on your perspective. And we're trying to get a handle on the amount of the loss. The focus usually is going to take one of two directions. Either we're looking at lost profits as a result of the wrongful act. What profits were lost for this business as a result of the wrongful act? Or we're looking to evaluation of the business. What's the change in the value of the business as a result of the wrongful act? They're two sides of the same coin. They're just different ways of modeling and organizing the information to get to the ultimate determination of economic loss. In a breach of contract action, which is one of the most frequent ways you'll see economic damages measured, we'll need to know, one of the things we'll need to know as forensic accountants, and whether forensic accountants will need to work directly with the practicing attorneys that have hired them, is to understand what type of damages are we trying to estimate. Are we looking at consequential damages? The damages that are the direct consequence of the breach. For example, loss of profits from a failure to deliver business equipment. It's not just that you didn't deliver what you said you delivered and I paid for it. It's also the consequential damages, the loss that resulted from the fact that you didn't do what you said you would do. Is it a measure of expectation damages, the benefit that was expected to be enjoyed from the contract? Does the contract provide for liquidated damages? Does the contract provide for its own measure of damages? So those are specific to issues of contract law. You might have otherwise a tort that won't have those contract law specific questions about remedies. But look, as with any question where we're measuring economic losses, the first thing that you need to do as a forensic accountant, as an attorney hiring a forensic accountant, you need to have a conversation together. The forensic accountant is going to have a section of their report that says the law of damages in this jurisdiction and says the attorney told me this was the law I need to work with. And that's important because it qualifies the forensic accountant's opinion as it's provided to the judge and the jury. You don't want the forensic accountant trying to tell the judge what the law is. In most jurisdictions, you're not allowed to do that. So the forensic accountant is going to need to rely on the lawyer to say what type of damages is permitted, what is the date at which damages need to be estimated, what is the interest rate on damages? Do we estimate as of the date of the beginning of the trial and then provide for interest on the damages? Do we estimate as of the date of the wrongful act? Is there a statutory interest rate? Those sorts of questions are legal questions, and the forensic accountant needs those inputs to the model to begin with. So they're going to need to get that advice from the attorney who hires them. Lots of conversations need to happen between the forensic accountant and the practicing attorney to nail down all of those parameters before you get cracking on getting the expert report and the ultimate measure of damages. The first stage, before we get to either the route of measuring the actual losses or conducting a valuation exercise of the business, is gathering information. We need to gather all the information we can. If this business has financial records, that's going to be useful. balance sheets, income statements, statements of equity, and cash flows. If they are audited by an accountant, and if they are uh, created and audited under general accepted accounting standards, or for public companies under PCAOB standards, if the information is created in compliance with generally accepted accounting principles, that's optimal. That is the easiest set of documents to begin to work from. Some businesses are not going to have this. And the client's going to say, well, all I have is tax returns I can give you. Tax returns are a helpful starting point. Tax returns are a place to initially start to conduct an estimate, but tax returns are often not sufficient. Company tax returns are not sufficient. First, some people are not, some people take positions on their tax returns that sometimes legal, sometimes illegally, sometimes perfectly legally, are aggressively designed to, at any point of discretion, minimize total income. So that might not be an accurate measure for you as you're trying to conduct an economic damages exercise. Another issue is that some income might not be included on the tax returns, just by virtue of the fact that it's going to be created as a result of tax accounting and not financial accounting. So the differences in accounting methodology, for example, depreciation methodology, could require some type of an adjustment. If we can get deeper on the particulars like customer invoices and bank statements, that's all going to be helpful. Financial benchmarks for a company, where I can compare this company to other companies, compare profit, losses, and ultimately value to other companies. I'm going to use data sets like Pratt's Stats, BizComp. So your forensic accountant is going to need to either already be subscribed to these data sets, or is going to need to add that in to the invoice if there's a particular subscription necessary for conducting an economic damages estimation. The expert needs to understand the initial facts and allegations in the complaint, and that's where some expertise across forensic accounting and law can be useful to understand that on the plaintiff side, are you reaching for the full measure of damages? And on the defense side, are you doing everything you can within the bounds of reason, law, and accepted accounting, forensic accounting standards to make sure that the damages award is reasonable, if at all necessary. You'll have some negotiation on issues like the scope, conflicts, engagement letter, scope of the opinion, what type of engagement it is. So if it's using a lot of discretion on the part of the forensic accountant, that is an opinion of value, and your forensic accountant is going to need some measure of independence in coming to that calculation. It's going to need to abide by standards like the standards of the AICPA or the NACVA for the purposes of the engagement. It could also be a calculation engagement, which is a much more modified type of engagement, one in which essentially the forensic accountant doesn't do very much and is given the parameters of their opinion. I frankly think calculation engagements are not very useful, not very compelling. But it is one type of engagement accepted by the industry. So moving to next points, you'll need to get to some determination of the standard of value that you're going to be using. Is it fair market value? Is it fair market value as defined by some generally accepted method, like the IRS's revenue ruling that defines key valuation principles? Even if you're not involved in a tax issue, you're just involved in a tort or a contract law situation in private litigation, looking to those standards as defined in the IRS revenue ruling might be a useful benchmark to use to define concepts in fair market value and other concepts in evaluation. You might be using fair value instead of fair market value, which can have distinctions as in, for example, appraisal law. You might be using investment value, which is the value of a business to a particular strategic buyer, looking through the lens of the strategic buyer and what they intend to do with the company they're buying. You might be looking at book value or intrinsic value. This is a balance sheet focused value that might have some adjustments to eliminate intangible assets or to remark to fair market, but otherwise, generally speaking, starts with the balance sheet rather than creating some discounted cash flow model of future cash flows. So you need to have some understanding of the standard of value that's being used. You need to come to an understanding about the premise of value. The premise of value is the two basic types are going concern or liquidation. Are we chopping this company up and selling off the parts, or is this a going concern? If we're chopping it up, if we're looking at liquidation value, there'll obviously be substantial discounts for the fact that it is harder to sell things for a premium when you have to sell them fast. The subject interest is a question that just asks basically, are we valuing the whole thing? Or are we valuing just a part of the thing, just a minority interest in the company? Now, once we've got all that nailed down, we've got all those parameters to our opinion, all the scope nailed down, the basic building blocks in place. Here we start on our adventure. Let's start on lost profits. If we're measuring lost profits, we have a couple different types of measurements here. One, we have to ask the question, has the business been permanently destroyed? Then valuation might be a more appropriate measure. Valuation of the business as it was before the tortious or contractual wrong, and then the zero value after, if permanently destroyed. Is it more of a issue of business interruption, where the business takes a hit and then eventually over time catches up to baseline? Is it a circumstance where the business takes a hit and never quite catches up to baseline, so that delta between what could have been and what is as a result of the wrong continues going forward over an indefinite time frame? Is it a time frame of interrupted losses followed by business destruction? Generally speaking, if we're looking at a difference between a future of actual profits and a future of expected profits absent the wrongful act, we're looking at some measure of lost profits, and we're looking at something like a discounted cash flow valuation that tries to estimate those losses. That's something that acts like that type of calculation. It's a little bit different, as we'll describe. The basic contours of a lost profits calculation, we're looking at change in revenue, and we're looking at change in variable cost as a measure of the damages. So the easiest one to get your head around is, look, something happened at some point in time, a wrongful act. And I have a graph of my profits. They were going up. Life was going well. Some bad thing happened, and boop, profits are there. And they're on a whole different line that's not as good as it used to be. So we draw my line of what profits were reasonably expected based on history and based on reasonable estimates of the future. And we draw the line of what actually happened, and the difference between them is my lost revenue. But we're not done yet. We're not done yet, because we have to ask another reasonable question that's going to constrain our lost profits estimate. We have to ask about variable costs. As a result of the lost profits, did costs decrease? If, as a result of lost profits, costs decreased, then we have to subtract that decrease in cost from the lost profits calculation, because that's costs we're avoiding. That's maintenance costs on new customers, new customer warranties that we didn't have to go out and do because we didn't get those customers. And so the very basic understanding of the lost profits calculation is, what was the revenue avoided, revenue lost as a result of the wrongful act? That adds to our lost profits number. And then what are the variable costs that we avoided as a result of the harmful act? We subtract that from our lost profits number. If there are extraordinary costs, like some major repair, that's going to add back to the lost damages measure, the measure of damages. If in order to keep clients, we had to give them rebates or discounts, we might add that back to a lost profits and economic damages measure. We might do some more sophisticated things to try to estimate what future revenue would have been if the bad thing had not happened, like regression analysis. Other issues to take a look at. One issue that can be a challenge is if the business is a brand new business. It can be hard if you just started out and you're not yet seeing those wonderful profits you expected, and then a bad thing happens. Um, there's no avoiding the fact that that's a more speculative exercise trying to find lost profits in a brand new startup business. It's not to say it's impossible, and there are court cases that permit it. Generally speaking, what you're going to do is you do the same exercise you would do otherwise, using history and using reasonable indicators of the future, the market that you're entering into, and the growth rate in the time frame in which you were in business. The other thing you're going to have to do is you're going to have to use a discount rate that appropriately takes into account the higher risk of a startup business. And there are a number of models out there to help you do that. So that's the basics on lost profits. The other approach you could do, especially if the business is just destroyed, is just evaluation. What was the business worth just before the bad thing happened? And then this business was destroyed. Therefore, that lost value of the business is what I'm going to call my economic losses. So how do you value a business? Well, valuation is something that comes up in a number of contexts outside of economic damages, but we can use that tool in economic damages. There's a few ways to measure the value of the business. So let's start with the simplest one, the balance sheet method. We take the balance sheet, we look at assets minus the liabilities of the business, and that's our value for the business. Simple enough, right? Except we're going to have to make some adjustments to the balance sheet to get there. We're going to have to adjust some of the assets to fair market value. We might have to adjust liabilities to fair market value if we think that we can potentially get away with not paying off all of our liabilities, negotiating with our lenders or something like that. And we might take off intangible assets, especially if this company is not a company that is primarily engaged in intellectual property. We might remove intangible assets from the balance sheet of that business. We might be using external appraisers in making those adjustments to the balance sheet. Especially if there's real estate, we might call an appraiser to come in, appraise the real estate, and then adjust the fair market value of the real estate on that balance sheet as part of the balance sheet method. A second approach, the comparative or market approach, basically kind of takes a macro view of this business and says, let's treat this business like a commodity, like a product. Did a business like this sell to a new owner at some point in the past? We can use data sets to try to look for that. Or we can try to say, is there a company out there that's publicly traded that's similar to this business in some way? And then we'll look at that comparable company and we'll say, what's the what is the multiple of some useful multiplier? In other words, we find some comparable company out there either that's publicly traded and we use the share price as an indicator of its value, or we found some company that sold, some private company that sold as a whole, and we say, okay, that company sold at 10 times its revenue. I think probably my company, since we're comparable, is worth 10 times its revenue. That's a very simplistic way of doing it. You can have a lot of different types of multiples, and the finding of comparable companies is where the real practitioner art comes in, and where you'll find the battle of the experts kind of evolving is a battle on, that's a comparable basket of companies. No. That's a comparable basket of companies. That's how the comparative or market method ends up sort of shaking out. But that's the basics of what that is designed to achieve. And then our third method is the income method. This is also called the discounted cash flow method. We try to estimate future earnings going into the future, and we estimate those future earnings by looking at growth in our revenue, growth in our costs, and then taking those numbers and then using net present value calculations to discount those values into the present date. A lot of the art goes into determining the right discount value. And this isn't a discount value lecture, so I won't belabor the point, just in the interest of brevity. We'll probably do a full-out discounted cash flow and discount rate lecture in the future. But that's the basics of that approach. That's kind of its own discussion. Basic differences between the business valuation method and the lost profits method. Under the business valuation method, you're using after-tax cash flows. The period of damages is perpetual because part of the business valuation relies on a terminal method that looks to profits in the future, models profits into the future indefinitely. Future incomes discounted back to that date of valuation, that zero date. And then if appropriate, if the jurisdiction allows, is brought forward to reflect prejudgment interest. Income before the event of the loss is used to project income going forward. That's projections of your revenue and your costs. And then the valuation date is the date of the legal wrong or the event of loss. For a lost profits analysis, by contrast, the cash flow that you're using is before tax cash flows. Your period of damages is really going to depend on the fact pattern in the case. Discounting future lost profits is done back to the date of the trial and then brought forward with some kind of a prejudgment interest if that is necessary and used in the jurisdiction. You're projecting future income as the but-for income adjusted post-event. In other words, the income you would have gotten but for the wrongful act that occurred. Any mitigation of damages that occurred or could have occurred. You're also adjusting for costs avoided. And then the valuation date is going to be the trial date. So that should get you started in helping you find an expert, learning how, as a practicing litigator, learning how to go find that forensic accountant that can help you get a precise, fair measure of economic losses. Sometimes I hear people say, oh, in my case, our case is not about accounting, so we don't need an accounting expert. No. Trust me on this. A forensic accountant is a different type of accountant who's really focused on a number of things, sometimes catch the bad guy, follow the financial illicit proceeds stuff, but uniquely useful. And one of the ways in which forensic accountants are most often used in litigation is in the measurement of lost economic damages, essential to getting the right outcome in the case. Call us, see if we can help you. If we're not the right expert for you at Veritas, or one of the folks on my team is not the right expert for you, I will find you an expert, just in the interest of being helpful. If you give us the time to sit down and talk with you, we hope we can be helpful and hope ultimately to get you to a model of economic damages that stands up in court, that is credible, and that helps get a just outcome for your case. Thanks for listening, and we'll catch you next time.